Hi, my name is Marc Belaiche. I'm president of TorontoEntrepreneurs.ca. Thanks for watching. Are you a business owner thinking about what your business might be worth after COVID-19? Have you ever wondered how a business is valued? In this segment, we'll be talking about what a business is worth. And I'm joined today by Melanie Russell, president of Kalex Valuations. Melanie is a CPA CA and a CBV and has a number of other designations also. Kalex Valuations is a boutique provider of business, tax, matrimonial, transaction advisory, financial, commercial dispute, and forensic valuations. Thanks very much for joining me today, Melanie.
Thanks, Mark. Thanks for having me.
No problem. So conversation today is really about businesses and for business owners and entrepreneurs. So what factors do a valuator consider when valuing a business?
And this is general, so this is at any time. So the real factors that evaluators consider are the same that investors would consider. So I say that value is a many splendored term, and it's sort of a beauty is in the eye of the beholder. So evaluators try to estimate using logic and practical considerations what someone would pay for a particular asset or business. It all comes down to expected cash flows, risks of achieving those cash flows, alternative rates of return, and what the financial position of the business is.
So, from a layman's perspective, right? Somebody who's not maybe a designated professional accountant or whatever, kind of maybe walk me through, some of the changes that you might see in valuations from before COVID hit, let's backdate it to February and to today, and then maybe looking ahead to the future.
Right, sure. So that's a very interesting question, and that comes up quite a bit. Comes up in terms of many different scenarios, whether you're trying to sell your business or someone's going through a matrimonial dispute or some matter. The valuation data is really important. So what something's worth today versus what it was worth back in January may be different, or it may not be, in fact. So it's going to be a very situational specific and very fact specific driven analysis. So I'd say the basics of valuation don't change with COVID or no COVID. They didn't change in the dot-com bubble burst. They didn't change in the 2008 crisis, and they're not going to change because of COVID. However, some of the inputs of valuation may change. So for example, it's probably reasonable to say that investing in a business in the service industry is going to be riskier and that investors will require a higher rate of return in general. But that may not be true for grocery stores or pharmacies. So for some companies and assets, investors will perceive a higher risk and will require a higher rate of return on their investment to compensate for that higher rate of return or higher risk, sorry. This is going to translate into lower cash flow multiples, lower EBITDA multiples, however you're measuring the cash flow, and lower values for some businesses. But for other businesses, the relative risk measurement may be different. It may be lower, and someone may pay something more than what they might have paid before COVID. Multiples may also change for other reasons, such as financing availability. So often the way you price an asset is how you can finance it. So if you can get cheaper financing than equity, then you might pay a higher price. You might pass on that financing synergy to the vendor. But if you're having trouble financing a deal, or the costs of financing are higher now, that may translate into lower values. The valuation data, as I said, is also going to be a big issue. Whether you sell it now or you sell it 2 months down the road or 2 years down the road, that's going to affect the value. Another change I anticipate is going to be the extent of reliance on the past results. So evaluators typically, as do investors, look at past results as a guide to the future, because typically we don't want to rely solely on forecasts. However, the reality is when you're paying for something, what you're paying for is future cash flows, not past cash flows. So whether or not the past results of a particular company is going to be indicative of the future is to be seen. For some businesses, things will look totally different post-COVID. Some will look a little different. Some will look different for a while, and then we'll get back to normal. Some will be exactly the same or better. So evaluators are going to be relying, in some cases, less on past results, or they'll be doing many more normalization adjustments. They'll be asking for more projections, more scenario analysis. They'll be playing with the numbers a lot more, I suspect. So given the uncertainties and the significant changes because of COVID, some companies will have structural changes, some will have temporary changes, some will be midterm, and then there'll be a recovery. So I think you'll see a lot more reliance on what I'll call the discounted cash flow method, as opposed to a capitalized EBITDA method, for example. And so even if the historical results are used, there's going to be a lot of discussion about what normalization adjustments will be, such as, the government assistance, how do you deal with that, supply chain costs, marketing, staffing issues, etc. Another change that you'll likely see is the assessment of the financial position of the company. When you sell a business, you normally kind of pick what the working capital should be or what the balance sheet should be on closing. And there'll be an audit of the closing balance sheet. And to the extent it looks better at closing, there'll be some extra money given to the vendor. If it doesn't look as good as it was supposed to look, then that will reduce the closing purchase price. There'll be a clawback on that purchase price adjustment. I think you'll see more scrutiny or more time spent on what the balance sheet should look like, because I suspect people will be a little more conservative and will say you have to have a higher level of working capital to deal with some of the issues coming out of COVID. Another change I think you'll see is that there are fewer purchasers out there right now. There just are not as many transactions being done. Now, whether or not that's going to change very quickly, who knows? But due to the logistical problems of entering into or finishing up a deal, or just the concern about uncertainty, many potential investments are sort of taking a wait and see approach. So for companies that look to comparable transactions in the industry, I think there's going to be much less guidance in that regard.
Yeah, that's fantastic. Well, thanks very much for coming on today, Melanie. How can someone get hold of you if they, I don't know, looking to buy a company or perhaps looking to sell their business?
Sure, you can contact me by email, melanie@kalexvaluations.com. You can feel free to call me, 416-488-9590, extension 225, and happy to speak to anyone who's interested in talking more.
Great. Thanks very much, Kalex. Melanie. I was going to say so it's Kalex, it's Kalex, just in case.
Correct.
Okay, so, well, thanks very much for coming on, Melanie, and have a great day, and be well, stay safe.
Thanks, Mark. Okay.
All right. Take care. Thanks.
Okay. Bye.